This is for you to train your mind to think in different ways, experiment in different ways, innovate in different ways. So wherever there's a difference between the positions, when there's an ongoing position which is being closed, or if there's no position and a fresh position is being taken, in those cases, the difference between these position columns would be 1. Now, using this position column, I'm using my close-to-close returns and aligning positioning with the correct close-to-close returns. I can see that I get the strategy gross returns. Perfect. Now comes the important part, transaction cost, which is our notorious something that can break or make a strategy. Alright. So here we have got the turnover method, which we are going to use to compute the transaction cost. For that, first we need to compute wherever there is a change in the position. So as I said, we go flat. First we go from 0 to 1, then we go from 1 to 0, or 1 to -1. Hello everyone, welcome to the channel. I am Wahak, and today we are going to talk about the Donchian Channel trading strategy. So this trading strategy is very interesting because it's find its roots, or it's find its fame rather, in the total trading strategy. And these total traders, maybe you've heard about them, maybe you've not heard about them, but I'm pretty sure if you are in the world of trading and algorithmic trading, you must have heard about the total traders. Now, the total trading strategy, from which the total traders made millions of dollars, had at its heart and soul the Donchian Channel strategy. Now, this Donchian Channel was developed by somebody called Richard Donchian, and he was famously known for trend following. Okay, so this is a trend following strategy. In front of your screen, as you can see, this looks like 3 channels, very similar to Bollinger Bands. But trust me, it is not at all similar to Bollinger Band. It's something totally different. Okay, so we're going to understand this particular indicator. There, we're not going to just code 1, not even 2, but 3 different backtests. And these are going to be just 3 variations of strategy which we're going to try out. And then we are going to compare it across different asset classes. Alright, so stay with me. Before we get into the code, let us understand what this is about. So friends, the Donchian Channel indicator is about having these 3 upper, middle and lower channels. Okay, now these different channels, what are they trying to show us and how do we calculate them? So by default, there is a look back window. Okay, and in general, it is, if you see general charting platforms by default have 20 as the look back window. And this look back window is nothing but the last 20 periods. All right. So in the last 20 periods, first let's focus on the upper channel. Okay. The last 20 periods, whatever the high was, this becomes the upper channel. Right. And over here, if you notice that since price is continuously making new highs, the upper channel kind of gets pushed, right? But overall, in a downtrending market, when the market actually does not make new highs, rather it makes new lows, the upper channel remains static over here. Okay. Similarly, the downward channel is associated with the last X days or last N days lows. Okay. So the last N days would be the default 20 period on this chart, but we can play around with this parameter. So the look back window being 20, in the last 20 periods, this was the lowest low. So that Donchian lower channel sets itself over here. And as you can see, it says that no new lows made. You can see this is pretty much static over here. And in a downward phase of the market, a downtrending market, you can see it is pushing down, down and down. All right. Now let's come to the middle channel. The middle channel is nothing but the average of these 2 channels. Okay. So this is basically trying to show us something. Every indicator comes with a message, right? Now there are volatility indicators like Bollinger Bands. There are trend following indicators like moving averages. And there are even momentum indicators like RSI. Well, this comes under the category of a trend following indicator. Why? Even though it looks like Bollinger Band, is actually a trend following indicator because it clearly follows the trend and it is built upon the very essence of a trend. The very essence of a trend is in an uptrend, there are higher highs, and in a downtrend, there are lower close. Also, one of the reasons why I took this strategy is because this forms the very basis of trend following. Okay. Now, moving ahead step by step with how we would enter and exit. Now that you've understood how this is placed, the more intuitive or the most logical thing seems like, let's say, let's enter when the upper channel is broken, let's enter into a long position. Or when the lower channel is broken, let's enter into the short position. Okay, that is the general intuition. But when we want to code this strategy, we want to be highly accurate. We want to understand the various aspects which our eyes cannot easily see. Okay, so I'm just going to lay out some rules. While we come back to this chart later, let's do everything on the code for now. All right, so let us get to the Jupyter notebook. Now, before going into the backtest, let us understand how we can visualize this on Python using this Jupyter notebook. So I have this code script with me, which is already written. I'm going to explain some of the important bits. And this is going to be something you can actually get access to. Just go and check the description box below. So first thing first, we're going to import our libraries. I'm going to be using Yahoo Finance to download the data. I'm going to be using Plotly to plot the data and visualize it. Okay, so this is done. I created this one little function in order to actually download the data, which is pretty much simple over here. All right, now as we go ahead, let me just download the data and show it to you. Now this is the data we are downloading for the last approximately 10 years of the S&P 500. Okay, so SPYAT of data is here, and we have our data.head. We can see clearly we've got the open, high, low, closing, volume data. Perfect. Now moving on, in order to create this Donchian Channel visualization, I'll be using Plotly. I'm not going to the every detail of every core line over here. What I'm going to try to understand is that in order to create these channels in this data frame, I use this data frame and I created some more columns in this data frame. One of the important things to know over here is that when we saw the chart on the charting platform, you would have not seen that any particular line is crossing the Donchian channel on the upward or downward direction when it comes to the upper channel or the lower channel. But when I run this, the visualization from this particular Python code script, you will now see how the Donchian channel actually looks like. And this is about to turn, over here. So the Donchian channel over here looks somewhat similar, but there's a slight difference that there are places where the close actually goes above the upper channel, or in some cases where there's a market which is a downtrending market, you would see the close go below the lower channel. Okay, now this is not something which is saw in the chart previous to this, but the reason why I have plotted it like that and how I plotted it like that is something you need to know. So if I am trading today, okay, generally what I would do is I would look at the data which I already have, and I would not account for the data which I'm going to have by the end of the day. Okay, so in general, when you're looking at any indicator, it is highly advisable to not have any kind of look ahead bias. So over here, when I'm looking at this particular indicator, what I'm going to look at is the last 20 days high or the last 20 days low. Now for the upper channel, for example, I want to use the dot rolling, and this channel window is 20, assigned 20 to it, dot max. So this is the highest in the last 20 days, the column, high column. Okay, so the highest high in the last 20 days. But I have shift 1 over here. This shift 1 is actually to move the column 1 day back and actually associate it with the previous day's last 20 days high. Okay, so we don't have any look ahead bias. Okay, this would be highly applicable in certain style of strategies, maybe exactly not with the ones which we're going to try today, but this is in general very much applicable in strategy backtesting. All right, so now that we have understood this code, and then we understood that the middle band being an average of the two, what we can check out is how the data looks like. All right, so this is how the Donchian channels look like. Not going to spend too much time over here. This is something which we have already seen. So let's dive into the backtest code Let's understand the rules, etc. So what we're going to do is we're going to start with one baseline strategy, and in the next step, we are going to move to two variations or two variants of the same strategy. And why the same strategy? Because all of them are going to use the Donchian Channel indicator. All right. So before I go into the rules, let me just run you through some of the functions which I created, which are going to be used again and again by me. Okay. So first I import my various libraries. This is something we already did. Then I have one function which I created, download the data. All right. Now to download the data, I will use ticker as the variable for the ticker symbol. I'll be using our finance, and then I have the start date, end date, etc. Moving on, inside this function, I calculate two other things, so I don't have to calculate it later. One is the 200 period moving average, and second is the close to close return. All right, so return underscore CC or RET underscore CC is basically df close dot percentage change. All right, so this is sorted. Now moving on. So this is one function which helps me plot the strategy cumulative returns. All right. Now over here, as you can see, I have commented out a certain part, which is the buy and hold returns part. So we're going to uncomment it and check out how this looks like as well. But by and large, this function is something which we're going to use at the end of every strategy to see how our equity curve looks like. Perfect. Now we have the metrics table. Again, this is going to be reused again and again after every strategy, which is going to lay out the various metrics like the annualized return, the annualized volatility, the Sharpe ratio, the maximum drawdown of the strategy. So this is something which we need to be aware of. This is our strategy evaluation, and it is going to be used again and again, therefore a function, right? So these are just basic calculations of annualized return, annualized volatility, etc. I wish you can just go and see it for yourself by accessing the code. All right, moving on. So what is run these? No, I have not done this. So let me just run these. Therefore, these functions get saved in over here. Perfect. Now let's come to the backtest. All right. Now the baseline strategy, the long short strategy. All right. Now here, as I said before, this is not exactly the total trading strategy. All right. Because we're not using those position sizing rules, those exact entry exit rules. But it is a sort of adaptation or something which we have borrowed the Donchian Channel, the entries and exit part. Okay. So in this case, at the very baseline level, we have four different points: the long entry point, the short entry point, the exit long, and the exit short point. So why are these four different? You must be thinking that up to now you saw only the upper channel, the middle channel, and the lower channel. So let me tell you this, that in this case, one of the things which we're going to experiment with is that we take a different look back window for entry, and we take a different look back window for an exit. Okay. So when you take a look back window for an entry, which is of a higher time frame. So for example, we're going to take the example of 40 being our entry window. What happens is when the last 40 days high is crossed, then the strategy goes long, right? Then we go long according to the strategy rules. And if it keeps going up, well and good. But then if you look at the last 40 days lower channel, it's going to be quite a wide difference. And maybe we don't want that. Maybe we want to keep our equity curve smooth by keeping our stop losses a bit limited. So what we will do in those cases is we will take a smaller period for the exit window. Now this is something you can always experiment with, because in the backtest, this is something which is fungible. This is something which you can try out and optimize. But at this point, the logic is something which you need to understand. Okay. So the entry window can be different. The exit window can be different. Secondly, in this particular strategy, one important part is that once you go long, then you first exit the trade. It is not the kind of a strategy which is perpetually long or short. This is something which many of you may not be familiar with. Okay. So depending on the path of the price, if the first position which is initiated is a short position, and then regardless of where the market goes, regardless of the profit or loss, the moment our exit short comes in, when that signal comes in, we simply flatten the position. So from the position being -1, it first goes to 0 before it goes to +1 if at all. And similarly, if the position is a long position, the first thing which you do is, if you have position 1, which is the long position, when you exit the long, it flattens and becomes 0. And then you go and take a short position later if you get a signal. So at any given point in time, we are not flipping the trade entirely. We are going to first flatten the position. So that is an important note which we have made over here. And then trades which are executed at the close of the day. Now, secondly, what we're going to do is we're going to take a trade at the close of the day. Okay. Here in your long entry, long exit, we can see that a long position is opened when the closing price moves above the upper Donchian band. So we are not looking for higher highs, but we are looking for a close above the highest high. Similarly, for the downside, we are not looking for lower lows. Only we are looking for the close, which is below Donchian Channel. Okay. So everything is happening at the close over here. And even the exit is happening on the close. Alright. So we're keeping this part a bit simple. Right, obviously you can go and check out some variations, put your brains, and I would highly encourage you to do that. But these are the rules for us today. Where as far as that, based on, highly encourage you to do that. But for now, these are the rules for us. The baseline, long, short, Donchian Channel strategy. Okay, now let's get into the backtest code. For this, I've created a function, and in that function, the first thing I've defined is all these various channels. Okay. We're doing nothing with the middle channel over here. So here I have not really coded anything for the middle channel, but we do have two different windows. One is the look back window for entry and one is the look back window for exit. And for that reason, what I'm doing over here is that I have an upper entry, okay, which is associated with the entry window. And then the upper exit is associated with the exit window, and vice versa for the short position, where we have the lower entry for that with the entry window and the lower exit with the exit window. Okay. Now this is something which we will experiment with when we call this function, and you will see and get more clarity. Okay. Now, obviously we create our signals, the long entry, the short entry, the long exit and short exit, and then we create a Panda series called positions. Okay. Now this position, I'll come back to this part later. This position gets its value through this for loop, which we are going to write. And in this for loop, we are going to check according to the path of the price as to where is there a signal. So if there is a signal at all, then we take a trade. So if there is no position currently and there is a fresh signal that comes in, that is where we take a trade. So this is from where it's going to check that if the previous position is 0, then we take the long entry and we make position equals 1. Otherwise, if there's a short entry, then we make the position -1. Otherwise, we let it remain 0. Okay. Now this is the entry condition. Now the exit condition. In this case, where the previous position equals 1, if the long exit occurs, the position becomes 0. Otherwise, it continues being 1. In case there's a position with -1, so there's a short position. If there's a short exit, then it goes back to 0. Otherwise, it continues being -1. Alright? Now, this previous position is something which I told you I'll come back to. So, this previous position is basically I -1. So, depending on where we're looking at, we look back one period, in one row back in the data frame, and we see I -1. If that position is 0, then previous position becomes 0. And if it is 1, it becomes 1. If it is -1, it becomes -1. Now, in this very first little block, what I'm doing is I'm checking if this is the first row. So if it is the first row, then I can actually break out of this loop and continue with the next iteration. Now that I've assigned various different positions at various places, according to my strategy rules, what I'm going to do is I'm going to create a column called positions, which is going to actually be these positions itself. So now my data frame has kind of expanded from where I began. So we begin with just the open, high, low, close, and returns. And now we also have the various Donchian channels, and then we also have this position column. All right. Now, using this position column, I'm using my close to close returns and aligning positioning with the correct close to close returns. I can see that I get the strategy gross returns. Perfect. Now comes the important part, transaction costs, which is our notorious something that can break or make a strategy. Correct. So here we have got the turnover method, which we are going to use to compute the transaction costs. For that, first we need to compute wherever there is a change in the position. So as I said, we go flat. First we go from 0 to 1, then we go from 1 to 0, or 1 to -1 is something we non-jump to, right? So wherever there's a difference between the positions, when there's an ongoing position which is being closed, or if there's no position and a fresh position is being taken, in those cases, the difference between these position columns would be 1. So what I could do is, in order to actually calculate the turnover, I would simply see the absolute difference. So from -1 to 0, or 0 to -1, or vice versa, all of those would be 1, and the rest of the NaN columns will be zeros. So I've got my turnover column. Perfect. I simply multiply this turnover column with my transaction cost, which is my TC over here. So the transaction cost is something which I input in the function, and here I've got my transaction cost multiplied by the turnover. Now this will be subtracted from my gross returns. I'm going to get my net returns. So the next thing is to find cumulative returns, which I do 1 plus net returns dot come prod. Perfect. And these are cumulative buy and hold returns. And then the function returns the entire data frame. All right. So now let's go step by step and actually apply this function. Let's call this function. And for that, we're going to use this code set. So as you can see over here, what is being done over here is that I have got my download process state. Okay, so now this is something which I would like to run all together, but for your better understanding, let me just put this over here. All right, now this is going to first download the data. So now my DF looks like this. All right, so this is something which happened because it downloaded it. Now I'm going to take this second line of code and here, just to show you what happens when we run them together. So this is again getting an input as DF in our data frame and is going to get back DF for us. Now DF has assigned the entire backtest function. So to speak, the backtest function is being called and DF has been one of the parameters. All right. The transaction cost over here we take is 10 basis points and the entry window over here is 40. Exit window is 20. This is experimental. You can try something else as well. All right. Perfect. Now we look in df.head. Now so many different columns appear because this backtest function actually expanded our data frame. So we've got open, high, low, close, the return column, and so on and so forth. So many other things, including our net returns and gross returns and turnover and our cumulative net returns and so on. All right. So we've got all these columns. So the backtest has been done inherently. And now moving on to plotting DF. So again, I can do it in a separate set, but I just choose to do it over here to keep it neat. If we plot the cumulative returns, this is how they appear. All right. And I told you I'm going to uncomment and show you a comparison between the buy and hold and the cumulative, but we'll do it in a bit. All right. Now moving on, we tweak the metrics table to calculate and compare between the buy and hold returns and the strategy returns. And this is how the metrics table looks like. All right. So we have got annualized. So this is the cumulative return in the last 10 years, which is 10%, which is barely anything. Okay. The net strategy return is 1.06%. The annualized volatility is 16.61%. and so on. You can see the Sharpe ratio is very, very low. And the maximum drawdown is quite not impressive. It's pretty much, I would have been better with the buy and hold signal. Okay. Now, it is not every time important that this strategy should actually beat the market. But if the strategy can beat the market, not in terms of return, but a better Sharpe ratio, better risk-adjusted return, even that is okay. But that's not something we see over here. So, let me go back and check how the buy and hold return, if I were to uncomment that part of the function over here as it said, how would it look like? And the reason why I commented that was because the buy and hold returns are so magnificent in front of our strategy returns. This curve looks kind of subdued, so you can't clearly see how choppy it is. Alright? So this is buy and hold returns versus strategy returns. So the baseline strategy clearly is not that crazily impressive. But we're going to try some more variants as I had promised you. So let's go back and let's just comment that part out for now. So later we don't have to go back and do that. So here we go. See, just run this again. And now we go to our next particular strategy. Okay. So our next strategy, I'm running this again without the buy and hold. So this is how the strategy cumulative returns look like. Later we're going to try all these out with different instruments as well. So now moving on, one interesting idea that comes to my mind is, why not try the loss only version of this strategy? So you see, when it comes to equity markets, they tend to have a long-term upward drift, mostly because equities are backed by companies which create a long-term value, and therefore these long-term upward drift is seen in the trend. So in such cases, many quants like to actually apply long-only strategies to certain asset classes. Okay. So if we were to see how the long-only strategy can work on this same scenario, we can check out by putting it in a different way, by plugging in certain different rules. So first we have got a long entry and we have got a long exit after that. And that's it. There is no short entry, there is no short exit. Everything else pretty much remains the same. We have things based on the closing prices. It's not about higher high, but about the highest close above the higher high. Okay. And then we have exit, which is going to be the close. Now this depends on the exit window. Here again, we will experiment with 40 and 20. 40 being the entry window and 20 being the exit window. So you can get a fair idea that I'm going to take only long trades. And looking back, one thing which I can perceive is because of this long-term upward drift and this very strongly trending overall uptrend in the long run, I might get much better returns, and this strategy might prove to be slightly better. Okay. So let's see how this works. And also I will have lesser transaction costs because I have lesser transactions now, possibly. So let's check out. Okay. So now we have got our long only strategy. So I'm not going into every detail of this code, but similar to what we did last time, but not having the short position, we're going to create the long entry, long exit signals, and we're going to put our position through this entire for loop and later create a position column, and then finally create the net returns, and then finally get our gross returns. Deducting the transaction costs, we get our net returns, and then finally the cumulative strategy returns. Okay, so all of this is being done in the backtest, and here again, and now this time I'm running all the functions together. I've got the same data set, the same transaction cost of 10 basis points, and I have got our exit window and entry window to be the exact same as well. Now the only difference is that this strategy is long only, whereas the previous one was long short. Perfect. Now let's see. The cumulative return is 72.81%, which is actually much better and much smoother than this 10.03%. So over a 10-year period, we got 72.8% return, and the annualized return becomes 6.25. Okay. Now looking at these metrics again, it's not just about the return, and it is also about the Sharpe ratio. The Sharpe ratio seemingly doesn't improve a lot. But one thing which has drastically gone down is the maximum drawdown. So the maximum drawdown, had you held on to the trade using the buy and hold returns, would be 33.72%. But if you applied this strategy, you would have a lesser maximum drawdown, about 27.29%. So by and large, I see that there is some little movement. There's something better I got out of this experimentation. Therefore, I want to try something else now. So now time for the next variant. In the next variant, what I'm going to do is I'm going to take a long only strategy and add a 200 moving average filter. Moving averages are another trend indicator. But when it comes to the 200 period moving average, it is a trend indicator, but it is something which you associate with a very long-term price movement. So in this case, what I do is I keep everything else the same as the previous variant. That means everything is long only. But I have one additional condition over here, is that before taking entry with the entry signal, we got to check that if the price has closed above the 200 moving average as well or not. Okay. In order to do that, I keep everything same. And this time, one extra thing which I do is first I obviously pull in 200 moving average for my data frame, and also I use this condition called MA_OK. So if this condition is OK, we will actually take the signal. So our long entry signal has this extra ampersand and then the MA_OK, which means if these two of the conditions meet, then this is one, then the signal is true. Okay. And therefore, this MA_OK is a simple close above the 200 period moving average. Perfect. So this is our backtest as usual, and not getting too deep into it, but let's run all these functions together. And this time we have the 200 SMA backtest function. So while running this together, I'll get some of the stuff. First, like we just run this. Okay. Here, I get 61.29% cumulative returns. I get annualized return of 5.44%. I get a maximum drawdown 31.2%. Annualized value. So I see nothing improving, not the maximum drawdown. I don't see the Sharpe ratio improving either. I don't see, the Sharpe ratio over here was about 0.67, so it's actually gone down. And therefore, it seems like the only thing which slightly improved is the annualized volatility, which was earlier 9.31%, and now is 9.15%. So by and large, this is actually not giving me any extra results. In fact, it is shaving off 10% of the cumulative gains I was otherwise getting. So I would not actually really look so happily or enthusiastically into the results of the strategy. But what if I tried different instruments from different asset classes perhaps? So let's try something else. So now that we have completed all our backtests, I created this function over here to compare the different strategies. Okay. This function simply takes a dictionary of the various results and gives me back a particular table which neatly plots all the various strategy metrics. Okay. Now, which neatly plots on the return metrics. So now what I'm going to do is I'm going to try it with different stocks. Alright, so here I have made all these various inputs consistent, and you could try with different entry like head windows and whatnot. That's completely up to you. But let's try with the stock Apple. Okay, many of you have your favorite stocks, Apple, Tesla, and whatnot. Like some people like Bitcoins also, etc. So depending on the volatility of the asset, depending on the nature of the movement of price or the long run, you probably can see different results compared to what we saw with S&P. Okay, so what I'm going to show over here is that we're going to keep these parameters, and then we're going to keep this as our last 10 years of data. So our ticker is Apple. So let me just run this, now run this. And now we have all these three different backtests which are over here. And from here, we get all the various metrics. Okay. So let's run this. And finally, our comparison table is ready. which gives me a clear comparison of the three different variants for Apple stock. Okay, so for the stock Apple, if I look at the long short strategy, I get a mere 2.68% annualized return. I get a heavy maximum drawdown. But if I shift to the long only strategy, I see a 21.75% drawdown, which is much, much, much lesser. And I see a Sharpe ratio which is above 1, which is a bit impressive at this stage. Okay? And if I look at the annualized volatility, it has gone down significantly. If I look at the annualized return, it has gone up significantly. So all this is pretty good. And if I put the 200 moving average fader, I see that I get obviously a significant lesser drawdown than the long short strategy. And I see a pretty decent Sharpe ratio. But I don't see a higher return, higher annualized return, that's for sure. And that's okay. Let's try some other stock, and we can try Tesla. For Tesla, we can see that for the various different variants, we have the annualized return for long short is pathetic, 0.4%. But if you go for the 200 MA printer, you see your highest annualized return at 30.84%. Okay? And these are very close to each other. Okay, but one important thing is that a long short strategy would have almost a 80% drawdown, whereas in the other two cases, you have about 57 and 53% drawdown. Okay? The Sharpe ratio has improved significantly by going long only and having the 200 MA filter. Okay? And obviously I could experiment a little more. So I'm just taking one very volatile asset class, which is basically BTC USD. And then if I test over here, I see that the returns are actually significantly improving and shows the Sharpe ratio above 1 again. So now let's try Microsoft as well. So one thing which I see with Microsoft is again a very improved Sharpe ratio with the last strategy and a better annualized return compared to the long short strategy, much lesser maximum drawdown. So I see some needle movement by adding these different layers above our baseline strategy. Also, if I look back, I see the more volatile the assets are and the more long-term upward trend they're showing, they tend to show a much better returns, obviously because we're looking at a long-only strategy. So the purpose of this approach in this tutorial is clearly to make you understand how you can think in different perspectives as a quantitative strategist, as a systematic trader. Alright? This is not at all any kind of a recommendation. Not at all. This is for you to train your mind to think in different ways, experiment in different ways, innovate in different ways. So if you have some other idea, you try out that idea with a baseline level strategy and then add some layers like some filters, add some variants, and experiment across different asset classes and different instruments as to what the results and the metrics look like. So this was it. I'll see you in another video. Thank you. Bye-bye.